July 2015, it was reported that Toshiba was involved in an accounting scandal that overstated their profits by $1.2 billion. Brief history about Toshiba. They were a major supplier of radios, vacuum tubes, and military supplies for the war. When the oil crisis happened in 1973, they decided to invest a little bit more in R&D, which brought about new technologies. Major competitors were 3M, GE, and Siemens, and similar to the issues that Sean and Mario were talking about, we kind of had Toshiba is involved in so many different industries, it's difficult to find a true competitor, but these are the top three. They had an excellent reputation in the corporate world for their governance. They were first in the world for the first laptop PC and DVD player. Just a little bit of an interesting fact over here. In 1983, the two companies that put out Toshiba, Tokyo Electric, and Shibara Engineering, that's how they came up with the name Toshiba. But that was fun. In 2008, they were under a lot of pressure. The economic crisis happened. There was a nuclear plant meltdown as a result of the Fukushima earthquake and a tsunami also. And the Japanese yen was taking a turn for the worse. They acquired Westinghouse in order to get into other markets. They were looking for other energy options such as shale, clean coal, solar, and wind. But it ended up being a burden on them. So they faced these internal pressures. In 2009, management set profit challenges. Now this was interesting because a lot of the different companies that make up Toshiba, the company presidents, were involved in setting these challenges. They were unrealistic, short-term profit goals that everyone was expected to achieve. If the employee had a problem with it, the culture in Japan was such that they couldn't go to their superiors because they were fearful for their jobs. All the executives were complicit in these crazy accounting policies that they had. And the CEO was aware of it. Did I? Oh my. Yeah. When we look at GE, like I said, it was tough to find a competitor. Even with the flawed accounting that Toshiba was involved in, as we're going to see shortly, they still didn't stack up to GE. Their inventory moves faster than GE. Trying to find the point now. Their inventory turns over quicker. But still, the return on assets, they couldn't be matched. Return on assets with GE. Toshiba had a good equity position, but it wasn't comparable to the huge GE profits, so their return on equity went down. So the earnings management, how did this happen? How was it uncovered? The Japanese Securities and Exchange Surveillance Commission, similar to our SEC, had a request for some of the projects that Toshiba was involved in involving a percent of completion method. This then, in turn, what they found led to this independent investigation, large-scale independent investigation, which uncovered percent of completion method shenanigans, parts transaction accounting, their recording of operating expenses, and semiconductor inventory issues. We went a little bit further, and we also looked at their valuation allowance accounts, their discretionary spending, and their foreign currency transactions.
Thank you. Good morning, everyone. Good morning. So this is a brief snapshot of exactly what the irregularities were uncovered. What I did, or what we did rather, was we took the Japanese dollar, everything's in Japanese dollars, So we pulled the exchange rate at the time of the end of each fiscal year, and we adjusted it to US dollars. So you'll see Japanese is in 100 million yen, US is in millions. What we uncovered through the this section here is specific to the percentage of completion method. Their sales were overstated by $128 million, and their profit was overstated by $431 million. And you can kind of see the trend. You know, the bigger, as they dug a bigger hole, the pressure got bigger each year. When you look at the other three that Robin had mentioned here on the previous slide, parts transaction, the recording of operating expenses, and the semiconductor inventory, you can see that for the parts transactions, there was a $508 million profit overstatement, operating expenses an $88 million profit overstatement, and inventory a $267 million profit overstatement. So when you add the all four of these up, you're at just under $1.3 billion. We did not factor in the valuation accounts and discretionary spending into this number. We'll get into that a little bit later, that those are more, discretionary, as the word says, so we didn't really necessarily want to factor that into the hard adjustments that we ended up making to this. So first up is the percentage of completion method. There was a lot of issues here. The way that Toshiba uses their percentage of completion, they have an SP, which is pretty much their estimated income, and they have a net, which is their estimated cost. So in cases where their estimated cost was higher than what their income was going to be, they should immediately, the second they know that, they should immediately put a valuation account in place. Well, they would go months, years, maybe never, and they just ignore totally putting this account in. And what that would do was, short term, you're going to have a higher sales, you're going to have higher revenues, but in the long term, once it's all over with, you got to take that loss at the end. So instead of accounting for the potential loss when it was more likely than not to occur, they wouldn't account for it until it was a moral certainty. So that's their words.
That's awesome.
I thought that was a funny quote there. So the misuse of accounting method, they were very selective in whether or not they would apply the percentage of completion method. Sometimes, if they knew there was going to be a current year loss, they would just not apply it because they didn't want to put the valuation account in up front. If there were no reasonable cost basis, they would just make one up and take percentage completion method so they could take some sales in the current year. So they were kind of cherry picking whether or not to use the percentage of completion based on, can I get more sales, can I show less expenses? And also underreporting of project cost, as we all know from class, percentage completion, your denominator is your your total cost. So when you lower that denominator in year 5 of a project, well, all of a sudden your percentage completion number goes up and you can book more revenue. And those revisions of cost estimates were just pulled out of the sky in many cases. There's absolutely no backup for them to do anything. And they also wouldn't, there'd be subsidiaries that they wouldn't set purchase orders up with, so that cost couldn't be accounted for, and that cost would not be included in their cost basis, which would also help them raise their percentage of completion and their revenues. On to the parts transactions. I believe we talked about this in class, a masking price, which is a price that is charged, that Toshiba in this example would charge that's higher than the actual price that they paid to do this, so their competitors can't find the actual amount that they're paying for their inventory. So there's nothing wrong with that on its face, that's common practice, but what they were doing is they're booking the accounts receivable based on that masking price and reducing their inventory based on that masking price. So they're reducing their inventory at a level 5 times higher, and sometimes even more than 5 times higher than what they actually paid for the inventory. So they're carrying a negative cost of goods manufactured. This is a huge impact, and it's really all timing based. So at the end of each quarter, these transactions are happening, and they're just kind of, once you start that ball rolling, if you don't adjust it back next quarter, you kind of have to keep making this entry, or you're going to have a huge swing in the other direction. And lastly, it wouldn't be Thanksgiving week if we didn't talk about some stuffing. So Toshiba also did take part in channel stuffing. So it's pretty much this, what we talked about here above, only in this case, they would just absolutely overload their vendors with parts at the end of each quarter. I mean, send them more than they would ever need in the next 2 months. And they would book all of the sales at that time. Really, they should have been treating those as a repurchase, and should not have been taking the revenues until the PCs were actually delivered back to Toshiba and in a condition where they're ready to be sold. All right.
Okay, the next issue that was uncovered as a result of the investigation was the manipulation of operating expenses. They used a cash basis instead of an accrual basis for their operating expenses. And this allowed them to push around costs here and there based on quarterly targets. It was easy for them to do. They asked vendors to delay invoicing for services rendered. Toshiba was such a huge company, they had that kind of pull. They would increase the price of the product sold to the affiliates at the end of the fiscal period to pump up their sales numbers. And sometimes they were able to negotiate better prices with the vendors, but even if they weren't, they used those lower pricing in their inventory models and just made a mess of it. The last part of the investigation involves semiconductor inventory. This was an area that was slow moving for them. They didn't send up allowance accounts for the disposal of the inventory. What they should have done was establish the allowance accounts in order to value the inventory back at its book value and treat stale inventory as a loss. They never recognized those losses. The semiconductor inventory is interesting because they have a process which involves multiple steps. The physical flow of this inventory was separated into 2 phases. The front end would be almost like a raw material type of thing that would result in an intermediate product. And then the back end phase was taking that intermediate product and having a completed product, shipping it out to the people who needed it, and then they would get a PC back in return. So the front end, what they did is they manipulated the front end prices to make up for less production, but they wouldn't do anything with the back end prices. So as a result, the inventory was overstated on the front end, and cost of goods manufacturers was understated on the back end.
Okay. So we just covered all of the items that we ended up adjusting the financial statements for, which we'll talk about in a minute. There are also some other items, first of which is valuation accounts. So big one was the AR allowance. This red line here is their competitor average, GE. As you can see, in 2007, before they started having financial difficulties, they're right there. They reduced from 2.18 to 1.07 in this 7-year period between 2008 and 2014. The net of that is they were able to save $600 million that they, I guess, less expend or more revenue from more higher asset from their savings over time. And you can see each year, that as that number goes down, it's just as huge each year as they kind of got more difficulty. Deferred tax asset value was a little more complicated than that. In this case, in 2008, Toshiba had a $3.5 billion loss. So naturally, as part of that loss, they're going to have a higher deferred tax asset balance. So their deferred tax asset balance went from about 16% to above 30% here. So you think that's good, there's nothing going on here. But if you actually look at the deferred tax asset values, they increase each year between 2008 and 2012, 13 right? So what we wanted to do was actually show the difference in the change in net value each year, And if you actually look at the change in net value each year, you can see, I mean, it's just going down and down and down. So they really did adjust this downward, even though, just looking at the strict percentage of the deferred tax asset value, it doesn't really move much. In fact, it went up. When you actually dig a little deeper, you can see that it did. I mean, it was adjusted well downward, 15% less going into the last couple of years. Discretionary spending was another big one. So they never really had what I would call a healthy percent used up. I mean, it started at 71.7%, well, it went up to just about 80% here in 2011. They really just delayed a lot of infrastructure purchases, and my suspicion is this number went down in 2012, most likely because of the whole issue with the Fukushima plant, and they could spend a little more money, and the market wasn't going to penalize them for that, you know, understanding that, hey, you're going to have to make some improvements here. So they kind of had a little bit of a free pass there to spend extra cash. Also, the R&D and advertising, which are really important for a company for long-term health. You can see how the percentages, I mean, they really reduced their spending over time. There was a bit of a spike here in 2009, but I mean, you can see after that, in both cases, it drops. There looks like there was some sort of decision here made in 2009. R&D is about 5% of total revenue, and advertising, you know, on average about 0.5% of total revenue. They reduced their R&D spending from 2007 to 2014 by 8.5%. That resulted in them saving about $340 million. And they decreased their advertising by 26.7% between 2007 and 2014, and that helped them to save $118 million.
So as a result of all of the changes that were found to have occurred in this independent investigation report, and it was very detailed. They went through each of the 4 transactions that we talked about and actually came up with adjustments that should have been made at the time that the things were taking place. So what we did is we actually revised the financial statements. We took the financial statements as they were from 2008 to 2014, and we revised them based on the adjustments that were found to be necessary from this independent investigation committee. What happened with the parks transaction, I just want to point this out, because there was an element of profit as well as inventory, we had to make the assumption that there was a 10% profit margin on that. So that was just an assumption that we made. It ended up, whoops. No.
What's that?
Oh, really? Okay. Green button. Here's our 1.2, almost $1.3 billion end of the day overstatement of net income over 7 years, right here. $775 million just on the balance sheet alone. They didn't have a cash problem. Toshiba did not have a cash problem. Their cash was fine. And as you'll see in the next couple slides, their current ratio is fine. The adjustments came as a result of inventory. This short-term view that they had really backfired, because if the adjustments were made at the time, if they employed proper accounting and these adjustments were made at the time that they should have been made, it really wouldn't have had that much of an impact on each year as it goes. But because of this challenge, they were under a lot of pressure to reach these targets. And what ended up over 7 years' time was $1.2 billion. The ROA went from 0.9 to 0.2%, and the return on equity, and it's a shame because this is really testament to the effect of the common stockholders. The return on equity went from 2.1% before the adjustments, and after the adjustment, it was just 0.4%.
And one more thing on this slide too. During this time, they had a little under $1.4 billion of total net income between 2008 and 2014. this wiped out pretty much all of them. They would have had less than $100 million net income in a 7-year period without these adjustments being made. So just in conclusion, we have a couple slides here we'd like to talk about. So it was really difficult to nail down the analysis here because there are just so many things that they were doing wrong and pretty blatantly wrong. Not really a lot of gray area in a lot of these things that we're talking about here today. I think they're pretty obvious. But to nail each one down, and I mean, there still could be more out there that we didn't catch just because there's just so many issues. It's pretty crazy. And as I mentioned, I mean, their net income is virtually 0%. Without the misstatements, the pressure on the executives is big. I mean, in Japan, just like it is in the United States, the executives probably wouldn't be able to hold on to the job as long as they did without making these entries. If they're showing flat 0 income year after year, they're not gonna be around too long. So we'll talk about lessons learned here. Their internal controls were very inadequate. The executives could just override them. They would just put an order in, and that's what would happen. And no one could speak up till. So there was some thought on how we can improve that. One was a whistleblower system has been created within Toshiba to kind of allow if management is getting pushy. There is an avenue for employees to speak up against that without any fear of repercussion. Also, they got rid of their current audit structure and totally rewrote it. They now have an internal audit department that is very powerful and can ask for data on demand, and they have to get that data within, I think, 48 or 72 hours. And also the audit committee on the board of directors powers been enhanced as well. The profit targets, and this really goes back to the challenge that Robin was talking about at the beginning here. The profit targets need to be based on an understanding of the current business environment, the expected future cash flows, not just on this is what the market says we need to hit, let's hit that number. That's not the way to do business. That's the way they were doing business from 2008 on, and they have a total culture change going on right now. They got rid of 8 executives, including the CEO, 2 former CEOs that were still on the board in some capacity, acting as advisors. They got them out the door. 5 or 6 other executives were shown the door as well. So they really revamped their culture, and that tone at the top needs to change. That's kind of, when you really dig through this and you read kind of the anecdotal evidence here, it all comes back to tone at the top. The employees just didn't want to ruffle any feathers. They did what they were told. Not that that's right. That all started at the top and then worked its way down. All that being said, there are some additional issues that remain. So just as we talked about in class, the percentage of completion method, I mean, it's still based on estimates at the end of the day. There's still room there, evaluation accounts to kind of build yourself a little cookie jar if that's what you want to do. The compensation of executives, it's tied to meeting market expectations in a lot of cases. That there's a lot of pressure on that, a lot of money at stake. Kind of makes them want to act in a certain way. And also, very interesting, quite a few articles and papers that we read, noted that the Japanese culture, in a lot of ways, the executives don't necessarily focus on the value of the firm. They focus on growing the firm, and they'll spend whatever money they got to spend to increase their market share. Very different in a way than American firms. A lot of lavish spending, a lot of entertainment expenses. Entertainment expenses are actually allowable deductions in Japan, which is interesting, and that kind of just leads to this whole culture issue that we talked about. So that's our presentation. Thank you.
Yeah. So the company culture may have changed a little bit. Were there any changes in the regulations?
Not yet is the answer to that. So this is literally late breaking news. I think just this week you sent me an article saying they finally announced the fine.
Yeah, they were fined by the Tokyo Stock Exchange, but that was just a slap on the wrist type of a fine. But the fine that came down from the regulators, like the SESC, was, do you remember the
It
number?
was 70. It was 70 million.
Yeah.
It was large.
They had already reserved 8.4 billion, was it? Or 8.8, whatever it was. They had reserved that, knowing that all these issues were out there. They did make a reserve for that, which you can tell, maybe they are changing. Let's hope.
Yeah, let's hope they're changing. And the one thing that we didn't know here too is that their stock price dropped 40%.
40% on the day that this report came out.
Dropped 10.
Yeah.
So does Japan have a stock equivalent or?
They, you know, I want to say they do. I mean, I think that kind of the lessons learned went worldwide after that. Wasn't specifically noted anywhere. I mean, the one thing we did note, it was very interesting how easily that they were able to get around these controls. I mean, they were toothless. They did nothing for them. So, I honestly don't know.
Anybody going to jail for this?
Not so far.
Right, not yet.
Not so far. No.
Still going.
That's a nice question, oh boy.
Just keep answering. What do you think would happen to management if they do this here? No, I don't think they do this. Is it okay with after 2002?
No.
What is the possible outcome if Toshiba is US incorporated?
I think that in the U.S. they like to make examples of large corporations because people are so upset about the money that CEOs make governing these companies, and I think it would be similar to an Enron. I do.
And I believe they have to sign for their financial statements as well. The CFOs, not
CEO,
CEOs,
CFO both sign
both
off.
have to sign off on it. So that's criminal liability.
Exactly.
Yeah.
And they have to pay back compensation, cash bonus they got,
Right.
claw back.
Call back. Yeah.
Pay back. Good, good.